Hi friends, welcome to the fourth video of fundamental analysis. In our last video, we saw how to read the financial statement. But understanding the financial statement other than say revenue, profit from financial statement is not an easy task. So the main use of financial ratios is to convert the numbers in financial statement into some useful terms so that anyone can easily understand the company's future. For example, debt in isolation in their financial statement is a number. So you can't judge anything out of that. It will only show whether the company is having some debt or not. But whether that is a safe bet, good debt, bad debt, that nobody knows. To understand that, the ratios will help. For example, in this case, so debt equity ratio is a ratio which will tell whether the company's debt is in a safe zone or in a danger zone. This is the importance of financial ratio. In this video, we will see all the financial ratios one by one based on importance. So let's start with valuation ratio.
Hi friends, welcome to a brand new segment of FinveStocks, Friday Basics, which will give you good insight about Indian equity market. My sincere effort in this segment is to create awareness to all in simple language. This series will be arranged in such a way so as to understand everyone who are beginners. Please share this video to all those who wish to learn, understand and participate in stock market. Please don't forget to subscribe and click the bell button to get the notifications of upcoming knowledge-packed videos on personal finance and stock market. Welcome back to FinveStocks, where we make everyone understand the basics of money management. Before going into this video, make sure you watch earlier videos of this series, which is mentioned in the I button.
Hi, welcome back to FinveStocks. In our previous video, we saw India's participation in stock market compared to other countries. In today's video, we will see financial ratio analysis. What is the importance of financial ratios? There are different types of financial ratios available such as profitability ratio, efficiency ratio, financial risk ratio, market risk ratio, valuation ratio, etc. So in our today's video, we will concentrate mainly on valuation ratios, which is a basic ratio. For any stock analysis, we will find the first term to be checked is PE ratio. So we will go deep into PE ratios, what is the significance, how it is important in a stock market analysis. So we will see other than PE ratio, PS ratio, PB ratio and PEG ratio. So let's start one by one. First one we will see what is PE ratio. PE ratio is price to earning ratio, the price of the share to earning per share. This ratio is initially popularized by the legendary value investor Benjamin Graham, one of the Warren Buffett's mentor. So there are two terms in PE ratio. First one is the trailing PE ratio that is calculated based on the past 12 months data. And the other one is forward PE. Forward PE is calculated based on the future data. So what is PE ratio? PE ratio by formula it is price per share divided by earning per share. For example, suppose one company is having an earning of 100 rupees per share and the current price of the share is 1000 rupees. What does that mean? It means people are ready to pay 10 times of the earnings for that stock. In other ways, we can say PE ratio of that particular stock is 10. So next comes earning per share, EPS. By definition, earning per share is total earnings to outstanding shares. So how to calculate this? This can be calculated from the profit and loss statement. So in a profit and loss statement, the first one will be the revenue. So revenue is the total amount generated by that company in a financial year. Then comes the expenses, then comes a tax, depreciation and amortization, and finally comes the net profit. That is the difference between the total earnings minus total expenses excluding tax and depreciation amortization. Here in this example, it is approximately 2 lakhs. So earning per share is 2 lakhs divided by total number of shares, that is 10,000. Comes around 20. So now we will see how to calculate price to earning ratio. So what is the importance of PE ratio? So it is the best ratio to compare companies' valuation in a specific sector. For example, say if you have 2-3 companies of a same sector. So just to identify which one is undervalued, which one is overvalued, we can use PE as a metric. So PE ratios are not an absolute measure. It will give only an indicator. So sometimes it will show high, the overall PE will show very high, and sometimes it will show very low. The general trend is like high PE will happen on economic booms. Like say if there is some bull run going on, that time all the PEs for each and every company will be inflated. However, the higher PE ratio can also mean that the company is growing very fast. A rise in PE for a company could be due to improving financial fundamentals, which could justify the higher valuation. Whether a company's PE represents a good valuation depends on how valuation of company with other companies in the same industry. So just by seeing PE ratio number, you can't judge a company fully. PE ratio can be used as a dipstick to evaluate the company. Generally, in my experience, the higher PE ratios normally shows good growth. So you should focus more on higher PE ratio companies, because why they are commanding so much high PE? Because there is good potential or good growth foresee in the future. On the other side, companies having low PE ratio is very undervalued. But what is the reason for that undervaluation? That we need to carefully assess, because companies having generally lower PE will be slow in their growth. So generally people will avoid that stock. One should not take a call based on PE ratio whether we need to buy the stock or sell the stock. PE will only give the indication how the company is performing compared to other companies of the same industry. Now let's see the practical application of PE ratio in a real-time example. So here we have two profit and loss statement. One is for company ABC and other one for XYZ. So for company ABC, the stock price is 100 rupees and total number of equity is 50,000. So EPS is around 2 lakhs divided by 50,000, that is 4. So PE ratio for company ABC is 100 by 4, that is 25. Similarly, we have a company XYZ. There the stock price is 1000 rupees and total equity is 5000 and EPS is around 50. There the PE is 20. So what you can infer out of that? Seeing the stock price, it seems to be XYZ is highly priced. But if you see the PE ratio, XYZ is having lower PE. That means it is an undervalued company compared to ABC. That only shows the affordability of a person to buy that stock. But in terms of valuation, the stock XYZ, that is 1000 rupees stock, is cheaper compared to the 100 rupees stock based on PE ratio. So always higher PE command higher valuation and lower PE commands lower valuation. But that doesn't mean ki higher valuation companies are bad or lower valuation company is good. It can be vice versa also, because a company is commanding higher PE because the company is having good growth prospectus in future, or it is accounting lot of good factors which is going to come in future. So you should never judge a company only based on PE ratio. This will be used as an indicator to do the further analysis. So as a summary, the PE ratio can be applied for all type of companies for a quick evaluation or for a dipstick check. Don't give over importance to this ratio, as this can mislead your overall analysis. In layman's point of view, the PE ratio shows how many times of earnings investors are willing to pay for a particular stock. The next ratio is PB ratio, price to book value ratio. So to understand PB ratio, first you should understand what is a book value. By definition, the book value is total assets minus total liabilities divided by total number of outstanding shares. In layman's point of view, suppose one company is going bankrupt. The company wants to sell out. Then what they will do? They will evaluate what is the total assets available with the company, like let it be land, let it be building, machineries, everything. So they will have a value of total assets minus the total liabilities is what all loan took for that company's operation, what all debt company incurred. So it will pay off all the debts, loans, etc. Then what all amount left divided by total number of outstanding shares. So it will give a picture like what is the book value of the company per share. So PB ratio is market price at that point of time divided by book value per share. So the formula of price to book value ratio is share price divided by book value per share. That book value per share is nothing but assets minus liabilities by outstanding shares. So what is the significance of a PB ratio? This PB ratio is only considered useful in the practice when it is applied to capital intensive business such as energy like Reliance Industries, like for large capital good companies, L&T, Larsen and Toubro. Then comes financial business where a significant amount of assets are there on their books. For these type of companies, PB ratio is a good metric to evaluate. The PB ratio will show how much times of book value the investors are willing to pay for a particular stock. This price to book value is calculated by dividing stock price to book value per share. A low ratio could imply the stock is undervalued, while a ratio higher than its average can be termed as an overvalued stock. But on the downside, PB ratio doesn't consider the account of net profit generated by the company. It will only account on basis of book value. The next one is PS ratio, that is price to sales ratio. The price to sales ratio is a valuation ratio that compares a company's stock price to its revenue. So as per formula, the price to sales ratio is price per share divided by sales per share. The price to sales ratio shows how much investors are willing to pay per rupee of sales for a stock. The price to sales ratio is calculated by dividing stock price by underlying company's sales per share. A low ratio could imply the stock is undervalued, while a ratio that is higher than average could indicate the stock is overvalued. So one of the downside of price to sales ratio is that it doesn't take into account of whether the company is making any profit or ever made some profit. A company is having no earnings also can show good price to sales ratio. The last one is the PEG ratio. PEG ratio by definition is PE ratios by earnings growth rate. For example, if the PE ratio of a company is 25 and the earning growth at the rate of 50%, then PEG ratio is 25 divided by 50, that is 0.5. So what is the significance of this 0.5? Like if it is less than 0.5, we can say it says a strong buy because there is a long good potential growth available in this company. If the PEG ratio is between 0.5 to 1, we can assume as it's a good buy. Similarly, how to consider the PE ratio for what to take the action, that is based on this thumb rule, it's available. So all these things you should take as a judgment call, that's all. You should not fully depend on these ratios for deciding whether we need to buy or sell the stock. PEG ratio is a good metric to assume the future growth of a company. That is what we can infer from this PEG ratio. So for beginners, we covered all the basic ratios one should understand under valuation ratio. We covered price to earning ratios, price to book ratios, and price to sales ratio along with PEG ratio. So these are the four important ratios under valuation ratios. In our upcoming videos, we will see other ratios one by one based on the importance of that ratio.
Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday basics to make your stock market journey easy. Thanks for watching and have a good day.